Here's the chart that I've not shown anybody yet. This is the Fed balance sheet versus the interest payments leading by 36 months.
Mm.
And this goes back all the way back to the beginning of QE, and it's amazing. Now, it's suggesting now should be in the, obviously we had this little spike from the banking issue. Now it suggests that it should be slowing down in its rate of change and eventually starts going up in Q3. Let's see, right? We've never used this before as a forecasting tool, but the correlation between this and the longer term version of this was pretty staggering. It's like, holy shit, it's just 36 months delayed payments is coming on the balance sheet. So that's the big hypothesis.
As the crypto markets continue to grow and mature, macroeconomic factors are beginning to exert a greater influence on them, similar to traditional finance. In the early days of Bitcoin and crypto market cycles, the main driving force was the occurrence of halving events, which happened approximately every 4 years or every 210,000 blocks. These events involved the halving of block rewards for miners. The next halving event is scheduled for May 5, 2024, which will reduce the reward from the current 6.25 Bitcoin to 3.125 Bitcoin. However, other significant influences on Bitcoin and crypto markets could emerge, such as the M2 money supply, which has shown a strong correlation with market movements in the past decade. Raoul, the founder and CEO of Global Macro Investor, recently shared a chart comparing the global deviation from the trend of the M2 money supply with crypto market capitalization. The chart illustrated the situation as of July 22 of the previous year. Powell noted that there has been another surge in Federal Reserve liquidity, as anticipated, with 11 months of quantitative easing implemented in less than 2 weeks through a $434 billion injection. This increase in liquidity has also brought the S&P 500 back to trading at fair value based on domestic liquidity. Powell emphasized the significance of liquidity for current risk assets, stating that it is the most crucial factor at present. In this video, Powell delves into the liquidity cycle of the Federal Reserve, using informative charts to illustrate the different phases. The video provides a comprehensive understanding of the liquidity cycle, showcasing the impact of liquidity on the market. It is recommended to watch the video as Powell effectively explains the concept with the help of highly illustrative charts.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
My general view is, from the work that we do at GMI, I think the market's priced in, and I've talked about this many times, a recession last year. So the year-on-year rate of change, I'll show the chart later, of the NASDAQ got down to expecting the ISM to get to 37, deep recession. So we're on the backside of that as future liquidity is increasing. But also, a simple thing is, if you go back to 2018, the moment the Fed paused, the market's ripped. I've always said, after you've gone through a whole miserable year like last year, and you've got things like technology that's advancing, the narrative kind of builds and builds and builds, and the Fed take their foot off the beach ball and it's underwater, it explodes higher. And so you've got this kind of crazy disconnect where people can't get their heads around why the markets are rising. And it's both a matter of, oh, finally we can own equities and take some risk again, but also there is an underlying forward-looking element of the liquidity cycle and the business cycle that's priced. We're still in the downside of the business cycle that Darius and I will both go through in a bit, but markets often like to look forward somewhat, and that confuses people. People always look at today as the snapshot. Today's actually never the day. Today's news is not the important news. The important news is what's going on in the forward-looking stuff. Yes, liquidity, the regular styles of liquidity, but there's the different style of liquidity, which seems to be the Fed balance sheets, that I think is a debasement of currency. So all assets rise versus the denominator, which a lot of people can't get their heads around. And so optically, everything goes up. So I started using a different denominator to look at asset prices. Like the S&P's pretty much gone nowhere since 2012 if you use the balance sheet.
Yep.
In fact, real estate, gold, S&P 500, nowhere. While NASDAQ, crypto, up a lot. With NASDAQ one, crypto the other. Okay, because they're both secular adoption curves of technology. So you can understand why it does it. So that's the difference I've got with liquidity to most, this debasement idea, and that it has a very different, profound impact. In the Everything Code, and I'll send it to you, Darius, because it's like 18 years of work, and I got to, I think it's a thesis, it's a hypothesis, but I think I've got to figure out why it happens, which is, I think it's to do with the monetization of the interest payments of every of the major governments every 3.5 years, which is between the 3-year and 5-year average duration of their debt, which has made the ISM completely cyclical because everybody reset interest rates to zero. We had a global, I only realized this recently when I wrote the article. In fact, after I wrote the article, the global reset everyone's worried about or wanted or thought about happened in 2008 when all rates went to zero, was basically a debt jubilee.
Yeah, it was.
There's no payments at that point. So what's happened since then, the refi of the debt has created this cyclicality. And I figured out, and I'll show you the chart, which I've never shown outside of GMI so far, I'll show it in a minute, is that the interest payments exactly mirror Fed balance sheet growth. And I was like, holy shit, I discovered this by mistake. And I'm like, holy shit. And then it went down the rabbit hole that I then did the same for the UK, Europe, Japan, and they're all the same.
Oh.
So they're all monetizing their interest payments. So that's what ends up in the balance sheet plus any banking crisis, right? So that's the extra delta that adds on top. So then I started looking at it and realizing I think I've got I can look forward on the monetary cycle in this way because we've got forward-looking indicators. Now, are they going to hold all that stuff? Who knows, right? But I think I can look forwards, and I think I can look forwards out till end of 2025. And because of with our weekly liquidity index gives us a 97.5% correlation with the S&P 500, NASDAQ as well, that we can put prices on assets going out to 2025. Now, I won't show them here because I don't want everybody to go, Raoul's predicting this, because you know what it's like. We got a thesis, we don't know. But anyway, that's what I got to with all this. I'm going to show you some of the charts because I think you'll find them interesting anyway.
Furthermore, speculators continue to exhibit a high level of confidence, with the S&P 500 comprising 4% of total open interest. This sentiment extends to the bond market, where short positions remain near record levels, providing additional fuel to the existing dynamics. Powell proceeds to present charts that highlight the various correlations between the ISM, S&P 500, and other relevant factors, shedding light on the intricate relationships between these elements.
All the major governments got to 100% of GDP in debt, except Japan, which is 260, whatever it is. So when they get to 100% of GDP in debt, most of their private sectors are about 100% of GDP in debt, more or less. So if interest rates are at 2% and GDP is growing at 2%, I think of GDP growth as your income to service your debts.
It is.
So therefore, the government crowds out all of the private sector just by its interest payments. And in which case, the economy will keep shrinking by the amount that the private sector has to pay. So what they've done is removed the government interest payments. So then you've just got the corporate sector. And that is why, it's one of the reasons why it ends up on the balance sheet, but GDP is slow because we've got these gigantic interest payments. Because as you know, nobody pays off their debt. They just keep adding to it and refining it, and it keeps going. So that's what I kind of have figured out. And I'll show you some charts of this. But yes, it's the reason that's why the government can do it. It sticks it all on to not crowd out the private sector, because if not, everything blows up. So here's some of the charts. So we found, and you're familiar with this, is we found that the rate of change is actually probably more important.
Agreed.
Overall, but the overall trend of liquidity works very well as well. We both get high R squareds from doing this against multiple assets. So here's our weekly global liquidity. This is the G5 central bank balance sheets, this version. We've got some monthly ones. We've got various different liquidity indicators, but this one works extremely well. Financial conditions index, which is based around the rate of change of the dollar, rates, commodities. And that started picking up. This is why we picked up the low. It actually came in June when we picked up the low in Ethereum. And then we confirmed by about October as actual liquidity started changing. So that's when we started getting more aggressive on our technology bets and crypto bets. It has a 5-month lead over global liquidity. So this, and again, this is time horizon. I'm less focused on where we're going in the short term. There could be TGA stuff, whatever. We're not looking for exact matches here. We're like directionally, what happens? So directionally, this is suggesting, and this indicator has been pretty good for asset price and everything else. I'll come on to that in a sec. The ISM leads it by 15 months. And the reason being, which is weird, is because it's so perfectly cyclical. So each previous cycle looks like the next cycle. So we found that. Now, will this be persistent? I don't know, but I think it will be. So it's suggesting that forward-looking liquidity is going to go significant into 2024.
According to Raoul, he maintains the belief that the consumer price index will experience a significant decline over the next 3 to 6 months. He highlights that regional Fed supplier delivery times have been rapidly decreasing since March, which currently suggests a CPI closer to 0%. Furthermore, the GMI Financial Conditions Index continues to soar, driven by the recent weakness of the dollar, declining commodity prices, and lower bond yields. These factors are expected to act as a favorable tailwind for the ISM, Institute for Supply Management, in the coming months, as mentioned by Raoul.
So there's the weekly liquidity outright versus the NASDAQ, which is the one that you'll suggest, okay, this is probably rolling over. Maybe the TGA sucks from this. We don't know yet, but look, it's not going up. But the NASDAQ is. So that's got a lot of people saying, well, it's decoupling from liquidity. However, back in 2018-19, when the Fed stopped, it completely decoupled from liquidity then. This is this beach ball effect. So I'm like, okay, that's not unreasonable. I get it. And the year-on-year rate of change of liquidity and the NASDAQ is consistent. So I'm like, yeah, that's fine. I can see why the NASDAQ could outperform at this point. Crypto in 2019 at its peak was up to 300% and then came back being down 100%. It pulled back for most of the back end of the year. So it's like, okay, fine. We can see that as animal spirits come back in, the year-on-year rate of change of liquidity. So I've been looking at that the NASDAQ is outperforming liquidity. This financial conditions index was the thing that gave us a 9-month lead where we think we are on the business cycle. So whether this is the exact match dates or whatever, but it suggests we've got one more blast lower below, let's say 45, before we start basing. Now, as you know, the economy actually, GDP comes out a quarter later. So, you wouldn't see these numbers and you won't come out of a recession, even though it looks like it's very V-shaped from this. It suggests that, obviously, I think there's a lot of slowness to growth to come out of commercial real estate, the banking issues, a whole bunch of stuff. Meanwhile, all we're saying is forward-looking, our financial conditions suggest, okay, things are on the rise. And this leads the Goldman one by about 6 months or so as well, or 9 months. And that's what gave us this view on the NASDAQ, is the NASDAQ had priced for us 37 in the ISM. So that was like, okay, interesting. And that was where we thought from the financial conditions index, the ISM could go. So I'm like, okay, it seems fully priced. And most of the other asset prices were doing that as well. So that's where we got to roughly with our thinking with this. And that helped us get long at the right time. The other liquidity cycle we've used, just simply because it seems to be a better fit on the year-on-year basis, is Global M2 seems to work very well for Bitcoin. And that turned higher. Obviously, we know the Chinese have been increasing M2. I don't know where it is, 12.5% or so right now. And that's dragging this cycle higher. And I think probably Global M2 goes higher. So again, not looking for the wiggles here, looking for direction. We've probably got a M2 cycle at play globally. So whichever major countries that's a part of, and that should drive crypto. The other one I found really interesting, and I think I'm the first person to have found this one. Here's the ETH Bitcoin cross. Now, this will make sense to you. You're a financial markets guy. Stuff like junk bonds work out well from the bottom of the cycle upwards because they're riskier. So the smaller, less liquid asset tends to do better. The ETH Bitcoin cross seems to be a function of the ISM, which is the money supply, and the business cycle, which is really interesting. So it suggests we should be going into the Ethereum zone versus the Bitcoin zone.
Meanwhile, the market witnesses a record level of shortened treasuries, coupled with a nearly unprecedented dislocation of bonds due to the ongoing business cycle. This suggests that bond yields are expected to decrease significantly in the future. The M2 money supply, which encompasses physical cash, deposits, and less liquid currency like bank savings accounts, also plays a role in shaping market dynamics. With less money available to investors, caution is likely to prevail, particularly in high-risk investments such as cryptocurrencies. The rising cost of living crisis in 2022, marked by surging consumer goods prices and escalating fuel and energy costs, further exacerbates this situation. In the realm of crypto, there are recent developments regarding exchanges seeking registration with the U.S. Securities and Exchange Commission. A proposal from the Republican chairs of two House of Representatives committees aims to allow digital asset exchanges to trade digital securities, commodities, and stablecoins in a unified platform. This proposal, viewed as significant oversight legislation in the crypto space, addresses several concerns raised by the digital assets sector. However, the draft bill released by the leaders of the House Financial Services and Agriculture Committees still lacks Democratic support and contains provisions that maintain the SEC's authority in determining which assets fall under its jurisdiction. One pressing issue revolves around distinguishing between commodities and securities. Regulated crypto firms handling tokens or cryptocurrencies can argue that these assets are commodities, but they must provide a detailed explanation of their operations and demonstrate genuine decentralization, certifying that no single entity controls more than 20% of the assets. The SEC retains the power to challenge such claims by producing a comprehensive analysis that establishes the asset's categorization within its regulatory purview. For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.